We're kicking you off to the close here with Richard Saperstein, Chief Investment Officer over at Treasury Partners, joining us here in Studio 2 on another wild day in markets. And I know we're supposed to sort of look long-term, look through the short-term, but a lot's changed since, I guess, everyone got back to work here in September. And I think a lot of people are really kind of on edge as to, I guess, where we go next. I guess the question is, what's really going to drive this market? Is it politics? Is it still the Fed and the economy? What?
Well, it's going to be earnings because the Biden-Fed tightening is finally having an impact on weaker employment, lower manufacturing, and that's confronting the elevated expectations for earnings. So as statistics come out that are showing weakness, investors are trying to find the location of, are we going to end with soft landing, hard landing? And that's really the challenge right now for the market.
I know that there's been a lot of talk about the potential drop in rates that we're going to get, assuming that the Fed makes good on what the market is already priced in. Once we start to see that decline in Fed rates and we see the effect on the Treasury market and the fixed income space here, does that create a buying opportunity, or has the buying opportunity, should that have come, I guess, before the Fed actually moves?
Well, there have been several buying opportunities. Yeah. Last year, we added a lot of municipal bonds at 4.5% yields. Rates have dropped 100 basis points. Those bonds are now at 3.70 yields. Investors still should be adding municipals right here. Basically, if you have the drive like we have, which is the return of capital is more important than the return on capital, you want to have bonds in a slowing economy. So investors should be looking at their allocations and determining if they have adequate protection against that uncertainty of where the economy is going to end up in either a recession or a soft landing.
What we've seen over the last month or so, well, a few months actually, is financials, funnily enough, and utilities really outperform. You get some cyclical and you get some defensive. Do you expect that to continue?
Well, we really like the utilities because there's a shortage of any energy production, not energy in the oil sense, but electrification power in the country as a result of the build-out of data centers. If you look at the migration within the country, moving to Florida, moving to Texas, there's a real shortage there, and there are utilities to own in those states that have a long secular opportunity to build out power production and take advantage of the immigration into those states as well as data center growth.
So that's one part of it. Then what do you do with the likes of, say, financials and some of the other cyclicals like industrials or energy right now?
So, look, the financials, you'll hear from Mike, and you'll get the bottom line on that. But we like the sector, and this probably provides an opportunity to add to them. But we still are overweight technology. We think in the long run, it's a tremendous opportunity. As an example, Google's operating cash flow has grown 93% in the last 5 years. Stock's only up 99%. So you're buying on a cash flow multiple similar to it was 5 years ago. And it's similar with some of the other big cap tech names.
How much does that spread out beyond big cap? Because when people are looking at these valuations, obviously some are looking at the more traditional metrics, which are probably not relevant to some of those stocks. But once you get past those big cash flow generators here, does that cash flow multiple, is that still the right metric to look at?
We focus on the cash flow, which is why we own oil and the large cap tech, but we're not buyers of the small caps, the mid caps, international or emerging markets. We'd rather stick focused on the U.S. markets, larger cap, and there's a lot of opportunities in the market in different sectors, like technology. We think oil is very cheap, especially if you think about the world being a dangerous place, and at any point a flash could occur. So they're attractive at this point.
So what do you make of the moves, the recent moves that we've seen in oil? I mean, we talk about Brent dropping back below 70, WTI down. All the forecasts seem to be pointing to slightly tamped down demand, but I guess this might be more of a supply issue as well. Where does that leave oil going forward?
Well, I think the equities right now are trading with operating cash flows of anywhere from 15 to 25%. And you take out all the expenses that they need after that, and you're buying these companies at 10 to 12, 14% free cash flows. What they're doing is they're going to buy back stock, and they're going to pay dividends. Plus, you have a protection against a bad world that we live in.
But can they buy back as much stock as we might think if oil is at 50?
Not at 50.
Okay.
But many of them, like look at the Canadian producers, there's low extraction costs, and they're still going to be profitable and positive cash flow, even down to 50.
Did you just make a call on oil?
No, I'm just saying.
I think that was a what if.
Yeah, it's a what if. I'm teasing her.
If I knew that, I wouldn't be sitting here, man.
All right, 66 on WTI, 69 on Brent crude. Richard Saperstein, Chief Investment Officer over at Treasury Partners, joining us today to help kick us off to the close, a busy day.